Hi, this is Mike Maloney with Jeff Clark and Adam Taggart once again. Jeff, how are you doing and what do you got for us?
I'm doing great, Mike. It's an exciting day. Adam, thank you for joining us today, too.
Happy to be here, guys.
Article of the day, tweet of the day, chart of the day, all our usual stuff, plus a great meme. So stick around for that. And we're going to start with our tweet of the day because of what is happening in the gold and silver markets this morning. You probably are aware, but gold is down over 2%. Silver's down over 4%, at least as we're recording here. So I sent this tweet out this morning that says basically right on schedule. And I referenced this, the average annual silver gain and loss throughout the year, and encourage people to look at what happens normally in the month of June. You can see seasonally, June is one of the biggest drops of the year on average for silver. And I say here, I see weak hands and strong hands in Twitter land this morning. Be a strong hand. You do that by focusing on the big picture and then holding or buying and not blaming. I'm buying both metals and miners today. And yes, I did buy some silver already this morning at goldsilver.com. And I also bought a miner. So, but guys, let's get your reaction to this of what's happening in gold and silver land this morning here. Mike, what do you think?
Well, a couple of months ago when cryptos were peaking, I saw some huge gains that I had made and I sold quite a bit of cryptos. And I've had that cash sitting on the sidelines waiting for this pullback. I've been watching things like the commitment of traders report and so on. Now, one of the sad things is that this big plunge here happened on a Thursday, and the report comes out each Tuesday, but they don't report it until the following Thursday or Friday. And so I've got to wait until not tomorrow, but a week from tomorrow to find out what has happened today, basically, as far as the commitment of traders goes. But yes, I'm going to be using this pullback. Now, this pullback was driven both by the news, the FOMC meeting, and the seasonality. Your chart here is the average seasonality, and this is 1975 through 2000. What I'd really like to see sometime is a chart that takes just the bull markets, not the bear market from 1980 to the year 2000, but a chart that is averaging the gain and loss of silver and gold during the 70s and the 2000 bull market. So in other words, 1971 to January 1980, and then the period of time from the bottom in 2000 to today, and see what I'll bet the seasonality is even stronger when you separate the secular bull and bear markets. But yeah, I'm trying to be one of those strong hands. And so I put some cash on the side that was profits, some big gains in some cryptos for the thing that I see as absolutely inevitable. I just don't see that there's any possibility that gold and silver will not perform in the coming crisis. But I do see a possibility that the world's central banks may try and make it difficult for crypto investors because they see that as a threat to the fiat currencies. Adam, what's your take?
The only thing I'll add to what you said, Mike, is yesterday we had the minutes from the Federal Reserve released, and that revealed that in 2023, there is now a slightly higher expectation that we may be doing a rate cut or two in that year. So that's 2 years out. Something they may or may not do. It really was only a slight change in expectation from the prior release, and yet that's enough to kind of kick the precious metals where it hurts. And part of that's just because no matter when the Fed speaks, it tends to be bullish for everything but the precious metals here. But it's just sort of the traditional knee-jerk reaction of the market, both to the usual Fed speak, but also in theory here. If the Fed is going to be tightening and raising rates, in theory, that would be gold negative because it would be strengthening the dollar, and it would be, in theory, making real rates a little bit either more positive or less negative But there's so many unknowns between now and then. It just seems like such an incredible overreaction. To the chart that you guys just showed at Jeff's, for those people that understand the fundamental reasons to own the precious metals, absolutely none of that has changed. So if you are committed to a dollar cost averaging program, or want to be buying in lower, when prices is lower, expecting higher prices down the road, this is a great entry point.
Yes, good point. I bought today. Several other people, gold, silver, bought today, including Dan, our producer. So we're capitalizing on this pullback. We're looking at the big picture. So, well, guys, on to our article of the day, and this is on Zero Hedge, the world's frothiest housing markets. Flash 2008 style warnings. And what they're basically referencing here is a Bloomberg economics report that says the run up in global real estate prices over the last year, thanks to central bankers, has produced a warning signal unlike any other not seen since right before the 2008 financial crisis. And there's some great data in this article. It's worth skimming real quick, including a table where they show just how overvalued many real estate markets are around the world. You got to scroll down 2/3 down at the bottom of the table before you find something that's fairly valued around the world. So, Mike, what do you think? Overvalued real estate peaking like never before?
Yes, I just think that, it's totally insane. And this is all caused by the Federal Reserve and the world's central banks creating currency from nothing, which dilutes the currency supply and steals purchasing power from everybody. And then when it goes back into the markets, the Federal Reserve, for instance, buys mortgage-backed securities, which keeps interest rates low on real estate and makes it easier for people to buy into the top of a bubble. It's a wealth transfer that's going on that the Federal Reserve is coordinating. It's a wealth transfer away from everybody and away from the masses to just the people that either own their own home outright and don't actually owe on it. One of the things about real estate is people don't realize it's a leveraged play. It is just like margin stock, brokerage account. It's got leverage to it because one of the things that we don't see here is the mortgage rent ratio, which I would like to see. And that's the cost of carrying a house. If you buy a house with a 30-year mortgage, plus the insurance and all the other carry costs, can you rent that house out for a profit or not? And that is another one of the indicators. But this affordability index is we're back in Insanesville. And this is the almost everything bubble because the stock market is also way above, like the PE ratios are way, way above the 1929 peak when that crash happened. And so this is all the Federal Reserve's fault. And this, when the crisis comes, I've said before that in 2000, it was the stock market that crashed. In 2008, it was stocks and real estate. This time, it's going to be stocks, real estate, and bonds. This is going to be the greatest financial crisis in history because this is only the second half of the economic storm that started with the 2008 crisis that they just kept on papering over and papering over and papering over and kicking the can down the road. Adam, what is your take?
Well, it's similar to yours, Mike, but I want to be sensitive to some of the commenters on last week's video who said that they think I agree with you too often. So just for their sake, I'm going to have to try to argue the other side of the coin here for a second. But first, where we do agree, which is pretty much everywhere. This is completely the predictable result of our current Fed policy, as you said. When you combine record low interest rates and trillions of fresh new money into the system, I mean, what else is going to happen, right?
Fresh new currency into the system.
Fresh new currency. I'm going to get honked this week.
Yeah, he's going to get honked.
There are some structural reasons why housing, at least in the U.S., remains elevated, and it has to do with shortage of inventory. And I will be smarter on this subject next week because I'm interviewing Kevin Erdman, who is a housing specialist who has basically noted that we somewhat decimated the home builder industry after the 2008 bubble, right, which was largely a housing crisis. And we have been trying to rebuild that industry to catch up with demand for housing. And I think right now there's estimates of somewhere between 1 to 6 million. That's the housing deficit in this country, somewhere between 1 million to 6 million units. And so there is some part of supply and demand where shortage of supply is playing a role here. And I just followed the work of Doug Duncan, who's the chief economist of Fannie Mae, who actually still remains fairly optimistic about housing prices going forward for a couple of reasons. One, there's the tight inventory I talked about. Two, boomers are not downsizing the way in which the forecasters expected. They're staying in their homes longer. Oftentimes they're buying a second home or whatnot, but they're not selling the first home, largely because prices have been appreciating so much. They're treating it almost like a stock. Third, we've got a record number of 18 to 34-year-olds still living at home. And a lot of the forecasters like Doug see that as future demand. I'm a little skeptical about that, getting back to your affordability chart there, Mike. It doesn't really matter how many people want to buy a house. The question matters is how many of them can actually afford to buy a house at current prices. And we're definitely seeing that affordability is the worst outlook it's ever been for younger generations looking to get into the housing market. And last, Doug is pretty skeptical that the Fed really can't raise rates here no matter what they say. And why that's relevant to mention here is Doug actually does talk to the folks at the Federal Reserve. As the chief economist for Fannie Mae, he actually has a direct conversation with those guys. So, I don't want to discount too much what a true insider like him thinks. That said, probably one of the best and most impartial observers of the housing market, Robert Shiller at Yale, he's on record very recently, past couple of days and weeks in the media, saying that he sees, quote, aspects of a bubble in most housing markets across America, and that, quote, it's going to cause some pain when those bubbles start correcting here. So, long story short, I think a lot like you do, Mike, but I do want to keep an eye on what guys like Doug Duncan are saying. Last point, Robert Shiller, why he does think that we see some bubble aspects and sees a price correction, he does tell people, look, real estate's a lot stickier than a lot of other asset prices. He does not expect a sharp correction. He sees it to be much more gradual over time. At least that's the expectation he's trying to set.
Yeah, just before we started this, I went to his website at Yale, edu.yale.edu, and downloaded his latest, his Shiller Index of housing prices, and we have just topped the 2007 peak here in real estate prices, and he's adjusting this for things like building costs, population, interest rates, and inflation. So this is yet another indicator. And this is the indicator that back in 2005, my first recorded presentation at the Silver Summit, I presented this and said that real estate was in a hyper bubble and it was going to crash sometime soon. That was 2005. So here we are exceeding that peak. So it is a little bit, the fundamentals, I would agree, are a little bit different this time around. And we don't have all of the zero down, no proof.
Ninja loans, yeah.
The ninja loans, right. Yeah. So it's a bit different. The subprime crisis is not happening along with this, but the overvaluation is definitely there. So maybe he's right. Maybe it will be a much more gradual return to the mean.
That's some great input, guys. Thank you. Adam, that sounds like a very interesting interview with Doug Duncan. When will that be available and where can we see that? Is it on Wealthion or?
Thank you. Yes, it's wealthion.com, but just to clarify, the interview next week is going to be with Kevin Erdman, who is another housing specialist like Doug.
Very good. Sounds very interesting, getting some great input there. So, well, if you're liking this video, please hit that like button down below for us and the notification bell as well. So Real quick, onto our tweet of the day. And I love this tweet. It's from John Told. John, I hope I'm saying your name right. Imagine waiting around all day for a couple paragraphs from a handful of boomers who've destroyed our economy and driven wealth inequality for decades just to see what the market is going to do. So this is obviously in reaction to the Fed announcement yesterday. Adam, to you first. Give us a real quick summary of what the Fed basically said and your reaction to John's tweet.
Sure. And the Fed basically said that it's not going to do anything different in the near term. It's still sticking to its guns that inflation is transitory, although a lot of people think that creeping up in the dot plot of future rate expectations in future years, which is a survey that the Fed does of its market committee members, that some people are seeing that as a sign that the Fed is blinking, right? That the Fed is beginning to, at least internally, begin to admit to itself that inflation may be worse than it's saying publicly and is going to have to take action based on that. But, look, the Fed is not stopping. It's still pumping 120 billion of stimulus into the system every month. It is not pulling the brakes on that anytime yet. If anything, there is some chatter out there that the Fed may need to start tightening, which not bringing rates down, but just not buying as many mortgage-backed securities and other assets that it's doing every month. But the Fed is not talking directly about doing that yet. It's more sort of about thinking about talking about it. So again, really no major policy changes. The markets did take that dot plot shift as a bit of a negative, but they really just sort of wobbled. They dropped a little bit yesterday, but are back up today, and they're shrugging it off. Of course, the precious metals always seem to take it on the chin when the Fed really says anything. But as I talked about earlier, that is the main reaction to the dot plot we're seeing in the commodities markets. That's about it.
I think that it's just totally insane that, basically the tweet, the comment is that, we wait around for these guys that have proven to be sort of bungling idiots, that they have created all the wealth inequality and helped to, I just wonder if we had free markets and we had some sort of real money instead of fiat currency that can be created from nothing. I just wonder what the world would be like. I know that government would be much smaller, and I know that the financial sector would be much smaller. And I have a feeling all of that wealth would be in the rest of the private sector, and we would all be much better off. But the very fact that they can jawbone and say, well, maybe we're going to do something in 2 years, and then the markets react and gold tanks, that's just insane. That people put that much credibility into what these guys say.
Exactly. And just to ride on that, Mike, when you look at the predictions that the Federal Reserve has made, whether it's around inflation, whether it's around whether subprime markets contained, whether it's around we're ever going to have a financial crisis in our lifetime, they are always wrong. And yet the world still listens and rests on every word. It's just nuts.
It is. So what's next, Jeff?
Very good, guys. Well, on to some viewer feedback here. This is from Jamie Stone. Jamie says, I'm about done with silver. Rather cash it in and enjoy the rest of my life. Not much time left anyways before the you-know-what goes completely sideways. Mike, what's your reaction to Jamie's feedback here?
Well, his last part of the statement where he says before the new you-know-what goes completely sideways, that's basically when the you-know-what hits the fan. And that's the day you're waiting for with gold and silver. So to get rid of your silver and go to cash, just as we're getting to the point where the big payoff is finally right around the corner here. That's... I'm not much of a gambler, but I used to run a business many years ago that was headquartered in Las Vegas, and I had to spend a lot of time there. And I would walk through the casinos, and it's like that person that spends hours and hours at one slot machine and then leaves, and the next guy puts in a quarter or a dollar or whatever and pulls that handle and a big payoff comes.
Right.
So, Jamie, I would reconsider your position, but I do not give advice. I just tell people what I do. But this is the point where I'm doubling down. I'm using this pullback as an opportunity because I know that everything else is in a bubble. And the very fact that somebody is thinking about leaving the silver market right now, that sort of shows that it's not in a bubble. There's no bull market in history that ends before exceeding its previous high of the last bull market that I know of. And we actually did not hit $50. We hit $48 this time. And it was 50, I think the intraday on one of the exchanges was $53 and something, 53.85 or something like that in 1980. And so this bull market is not over. And we've been through this brutal grinding sideways pullback that's going to be ending soon. It would just be a shame to leave the slot. And this isn't a slot machine either. This is an investment that I see, to me, as guaranteed to pay off. Adam, what do you think?
Yeah, I just want to reiterate what I said earlier, which is that, the fundamental story for owning precious metals hasn't changed at all. And certainly, from yesterday to today, when people are kind of reeling from the most recent drop, zero has changed. In fact, I think we can make an argument that we feel even more confident in the long-term projections here. So, first off, I just got to remind everybody that precious metals are a volatile asset class. And they are also the mirror of truth to power, which is why you see so many discussions about how the authorities are trying to sort of suppress the prices as best they can, because a runaway gold and silver price really unmasks the devaluation that they're doing of our currency. So, you have to just remind yourself as an investor in this game, the prices they're going to swing. It's a volatile asset class. So you have to just remain focused on the fundamental reasons for why you own it and just tune out all the noise.
Tune out the noise. That's good advice. Yes, Adam, thank you. Well, on to our meme of the day here. But first, if you've not read Mike's book, he talks about some of these big picture reasons in his book that are just as valid today, if not even more so. You can do so for free. The link is below. And of course, subscribe to Adam's Wealthy On channel. The link there is below. He's got some great guests coming up, as we've talked about. So, well, Mike, share this meme of the day with us.
Well, this is this is at one of the meetings or some press conference, and it's, "Hey Jerry, what comes after a trillion?" So the next step, we used to measure the deficit and the debt in the millions, and then the billions, and now it's the trillions, and very shortly it's the quadrillions. I want to thank everybody for watching. Jeff, Adam, we'll see you later.
Take care, everyone.
See you later, Mike and Adam.